Speaking of Alternatives with Keshav Rajagopalan, Managing Director and Head of Product and Strategy at PGIM Multi-Asset Solutions. How are institutional investors thinking about allocating to alternatives? Are we in a risk-on environment? How are they approaching investing across geographies and strategies? And what is driving their decision-making? Keshav explores these questions with Matt Harvey, Head of Direct Lending at PGIM Private Capital, Sebastiano Ferrante, Head of Europe at PGIM Real Estate, and Stephan Wessel, Managing Partner at Montana Capital Partners, a private equity secondary mid-market specialist affiliate of PGIM.
In the summer of 2024, PGIM partnered with Institutional Investor to survey 250 decision makers representing 10 trillion of assets across the EMEA region. We wanted to explore how investors are thinking about their allocations to private alternatives in the current landscape and their plans for how these might change over the next 2 years. The study found that private alternatives make up approximately 25% of survey respondents' portfolios right now. However, 75% of the survey respondents anticipate taking on more risk in their portfolios over the next 2 years, with 36% expecting a substantial increase in risk appetite. This risk-on allocation is set to grow against the backdrop of increasing geopolitical risk, central bank inflection points, and other risks that investors must navigate. So in this risk-on environment, where might investors look to allocate and why? Today, I'm joined by 3 colleagues. Matt Harvey, Head of Direct Lending at PGIM Private Capital, Sebastiano Ferrante, Head of Europe at PGIM Real Estate, and Stephan Wessel, Managing Partner at Montana Capital Partners, a secondary mid-market specialist affiliate of PGIM. Matt, Sebastiano, and Stephan will talk about some of the key drivers of change and the strategies the results uncovered as focus areas of our respondents. Now, we're only going to be able to discuss the few stats of the study today, so if you're interested in the full report, which features further findings and regional insights, you can access it at pgim.com/what's-your-alternative, or you can request a copy at thought.leadership@pgim.com. So we'll start by setting the stage and focus a little bit on allocation intentions. Where is the puck going? Does more than 75% of respondents looking to take on risks seem about right in the current environment? Is this dovetailing with the conversations you're having with clients in terms of their consideration of private alternatives? What kind of objectives are coming through in these conversations, and how do clients see private alts sitting within their overall alts allocation or total portfolio allocation? We'll turn to each of you for quick thoughts, so maybe Matt, to start with you.
I think it's an interesting question, and I look first to aspiration versus practice. I don't doubt that investors that we speak to have an aspiration to be, generally speaking, more risk on. And in our world, that generally means a greater allocation to privates. But I think there are 2 constraining factors that we see in practice in terms of how quickly that capital allocation moves. First off is the concept of DPI. Capital generally has to be returned from portfolios before it can be redeployed. And I think, as most appreciate, with a pretty rapid rate tightening and monetary tightening cycle over the last 18 to 24 months, M&A activity and capital generally has been more locked up than has typically been the case as investors have ramped up privates allocations. So we think that's got to start changing before investors can realize their aspiration to deploy more into the asset class. The second concept is really quite simple, but if you think about the composition of these investors, mostly institutional investors, we separate the class into absolute yield seekers and spread-based investors. And if you're a yield seeker to fund a liability glide path over a period of time, the reality is, in recent periods, you could have remained in higher quality investment grade and cash-like alternatives to meet a larger portion of those funding. And so I think there's this dichotomy that ultimately will come back to what central banks do around rates that will either accelerate the ability to realize that aspiration to be more risk on, or frankly, continue to constrain it depending on the rate environment that we see going forward.
That's very helpful. And obviously, the liquidity piece is a theme we'll touch on a little bit more. Sebastiano, maybe coming to you, what are you hearing from clients?
I would like to add that the real estate markets are pretty much defined by what we call the Great Reset in valuations and market pricing, which has been severe. In Europe, for example, 20 to 25%. In the United States, maybe around 15%. Asia less, but Asia is correcting now. This has left deep gaps in the portfolios of a lot of the real estate investors. One has to see that real estate allocations during the low interest rate environment after GFC went up a lot. It was a good alternative to fixed income products, which real estate offered a good spread. 300 to 350 bips historically is a high spread over the risk-free rate. So investors expanded a lot. And as Matt was saying, one of the key problems is valuations are dropping. So they feel the pain in the portfolios. Money is not coming back from investors because assets cannot be realized. So we're seeing an environment where investors are sitting there and saying, well, I would like to allocate, but I don't have the capital. And that's pretty much defined in the past 2 years. And therefore, as Matt was saying, there's a big difference between intention, aspirations, and what you can do and exercise. And if I look at all the markets, there is an illiquid situation, not a lot of market transaction happening. And we had a market where there's little activity. Now, the intention of the investors is clearly to go up the risk curve. Everyone is talking about rather value add and opportunistic returns. This is where the focus is, but it's very hard to make it work. Expectations between sellers and buyers are very far apart. Valuations have corrected, but there's still not a willingness to sell. And that hinders the activity. What is interesting, I think, is that in the real estate market now, over all the markets, we see a stabilization in valuation since this quarter. And therefore, we start seeing liquidity come back into the core space. I think that's a very important sign for everyone that the market is stabilizing and will give everyone on the value add front an opportunity for more conviction about starting to invest and deploy and maybe increase the pricing so that deals can happen again.
I think both you and Matt hit the liquidity theme, and then the other one, Sebastiano, that comes up, and especially as you talk about the great reset in real estate markets, is the denominator effect. As a client and asset owner thinks about their total portfolio, they're using an allocation percentage, but obviously that can be skewed by what other asset classes are doing. Secondaries is obviously turning into an active solution for some of these liquidity challenges. So again, anything that you're hearing from clients on kind of the intention versus aspiration theme that both Sebastiano and Matt have covered.
So for us as a secondaries investor, we're spending a lot of time with our investors talking about the subdued exit environment and the resulting lack of liquidity that is required to effectively keep private alts flywheel going, as effectively allocators rely on those distributions from their portfolios to then service future capital calls. The other big topic, and Sebastiano just mentioned that as well, is one of elevated valuation levels in certain segments, at least, of the market. As a secondaries manager that pursues a balanced approach across LP-led and GP-led transactions, as well as acquires LP stakes from both larger and smaller funds, we believe that we have a pretty good understanding of allocation dynamics and resulting return outcomes in the current market environment. Or put another way, we see what is and what is not working effectively at the moment.
Investment risks can take many forms. We can't ignore geopolitical risk today. In addition, liquidity, credit default rates, and public market volatility all serve to remind us that it is impossible to achieve competitive returns in this landscape without accepting and navigating a certain level of risk. But where are the risks of greatest concern, and how can investors successfully manage them?
Stephan, probably come back to that theme in just a bit. We'll shift a little bit and talk about investment risk factors. I know we talked about liquidity challenges, some of the valuation effects underway in portfolios. But stepping back, not surprisingly, amongst our survey respondents, most are seeing an increasing in risk in investment decisions and in the investment landscape. And almost 60% said geopolitical risk would likely increase. And meanwhile, 36% felt volatility in public markets would continue, and 32% expect default rates in private credit to increase. So it's a pretty tenuous backdrop there. Matt, starting with you, it's probably safe to say that private credit has become the poster child when it comes to investing in private alts. I don't think there's a conference that I go to where private credit isn't the major theme, but the sector hasn't been exposed to a protracted downturn. What are your thoughts on this? What does direct lending look and feel like today? And maybe a little bit on PGIM's history in the space as well, because we've been at it for a while.
Sure. Well, I think it's actually an interesting place to start because when I began my career in private credit 21 years ago, the asset class was very much the back room of the conference. We rarely got to talk about it, and there wasn't, frankly, a lot of excitement about it. But I think therein lies the value of the asset class. It's a deliberate, consistent strategy to produce excess returns over comparable public, in this case, comparable liquid credit. And in the direct lending world, that means leveraged loans. So as we think about the market today, generally speaking, would say there's a decreasing or neutral correlation to public markets. When markets go through credit cycle and volatility increases, I think two things happen in privates. One, the skill set of the manager becomes that much more profound because much of the value that we can produce for our investors comes from not only originating and selecting an asset that we think is is better than a quote unquote market alternative, but actually more of the value comes with what we do with that asset after we select it and after we originate it. And then you get into two real components of return at a very simple level. One, you have illiquidity premium. When we invest at entry, we get paid excess return because simply the asset that we're buying is illiquid compared to a liquid alternative. But again, we have a bigger component in our observation from all the value that we can generate post-origination. And that's where I think real alpha can be measured in the direct lending or private asset class generally. And what do I mean by that specifically? You hear a lot about covenants and terms. You hear a lot about active management. Information advantage is one other area. These assets are inefficient, but if you can get to them as a manager and private context, get information on a regular basis, that's more impactful than what you can as a liquid credit investor. You can use all of those things to create excess return. And that, I think, is more valued through credit cycle as opposed to less valued. The final point I'd make on this is, and it's sort of interesting tying back to the survey again, there generally was an expectation from the survey that default rates in private credit would be neutral to decreasing in the near future, whereas private equity valuations would also be neutral to decreasing. And those two things almost conflict in a way to me, and they don't necessarily align with a higher for longer base rate environment, which of course, generally speaking, increases cost of debt service on companies and deteriorates coverage ratios and so forth. But I think if you then look through that, and as a private credit manager, what I hope that means is that there's confidence that private credit managers using these tools I just talked about, the ability to control the asset, create better information, and use covenants to manage risk in a way that's superior to liquid alternatives. I think that would promote some conviction that the asset class actually can perform better through a credit cycle in a period of volatility.
And Matt, you and I have chatted about this, that not all private credit is created equal. I think people always look at the yields, look at the headlines on where are spreads and what are achieved spreads, but it does come back to what's the loss experience, right? Because it is ultimately a credit game. So if you don't have that fundamental kind of bottoms up underwriting and the covenants and protections with it, things can fall apart quickly. Sebastiano, coming to some place where Matt actually just left off is the cost of borrowing. In the survey, 32% of respondents expect the cost of borrowing to trend higher over the next 2 years. So what does that mean for demand in real estate markets when you kind of think about debt financing and any changes and differences between the US, Europe, or other parts of the world?
Yeah, I think you're alluding to it already. You have to make a distinction between the different markets because Europe expectations is that when interest rates go down from the point where we are now, that trajectory, I think it's pretty visible and you can underwrite that. Where the US will go, we will see. I'm not sure if I want to speculate on that, but the likelihood of interest rates going down, and I think what the survey expects that rather those costs go up, I think I would agree to this overall. So they don't have the same market dynamic. And then in Asia, we always say Asia is one market, but it's not true, right? Asia is multiple markets, China, Japan, all kind of different market environments. So you cannot say there's one story going on. If I look at Europe and the US, I think Europe is pretty clear that interest and borrowing costs will come down. We've seen towards the end of the year that liquidity actually in the financing market and the debt market has increased again. Banks are back, alternative lenders are back, competition and competitiveness has increased, margin go down. We have a bifurcated market. So we have, I call it the have and have nots in the financing market. Yeah, there are the one assets that everyone wants to finance, logistics, beds and sheds, where there's a lot of competition about margins and spreads are coming down. And then there are the other assets that no one wants to finance, and they're totally illiquid. That's an interesting theme. And the other interesting theme for me is Europe is one of the few markets worldwide, Japan as well, with positive leverage in the real estate market. You put leverage on an asset in real estate because you want to have a positive leverage. Now, Europe is the exception, and continental Europe specifically. Interesting market dynamic, haven't seen it before. For us, it means that on the real estate equity side, for value add returns, Europe is the better proposition because we have what I call accretive leverage in the system, and which is going to be more accretive going forward. We have what I call pockets of growth, which will be defined by low supply. We have an incredibly low supply in certain kind of markets and asset classes, which means that even if the economy is not growing a lot or sluggish, rents will still increase. And we have a very illiquid market in Europe. And therefore, market opportunity today is you can buy below valuations, which is an interesting proposition. The US is on a different pathway. And I agree there with the results. I think lending costs will go up, debt costs will go up. And the only way for this market to function with that negative leverage is the US has to produce a lot of rental growth going forward, which is the expectations in the market.
Each of the major risks that institutional investors face has an impact on other primary considerations and investment risks, adding to the challenges and complexities of investing in private alternatives in a volatile time.
It seems like we're at an inflection point, but I think your point on the US, Europe, Asia looking very different. You got to really look under the hood to understand what's going on in each of these markets. And then even within those markets, a lot of differences to untangle. So an important way to approach it if you're an investor. Stephan, coming to you, related point here, as base rates, borrowing rates are projected to remain elevated, investors' cost of capital are also increasing. 31% of respondents expected their cost of capital to increase over the long term. So what does that mean on valuations in the private equity market? That also presents liquidity challenges, as we've talked about. So what are you seeing in both liquidity, but as well as the fundraising game as you kind of think about flows into the asset class, and how should investors navigate this?
So if allocators expect the cost of capital to increase, irrespective of the underlying asset class, this would obviously impact valuations. And this expected shift in asset prices will then trigger portfolio rebalancing. So expanding on the thought of declining PE valuations, this may then inflate or overweight the relative allocation to other asset classes, which may make investors hesitant to commit more capital to those asset classes. In return, with heightened caution, LPs concentrate their commitments on well-established, probably top quartile managers that offer more perceived security or stability, which makes it harder for new or smaller firms to raise capital. And this trend had actually been quite noticeable over these past few years, where the largest firms have raised significant amounts of capital, probably to a point, and this is a personal opinion here, where it has become fairly unbalanced. Another way for LPs to navigate this is really by shifting their manager selection to more defensive strategies. So you can do that across asset classes. This could be, for instance, that you lean more into infrastructure or secondaries away from growth-oriented strategies or VC. Or you can do that across sectors, which could mean that you prioritize more defensive industries and end markets such as healthcare or B2B business services. Also, LPs react to this by allocating capital towards co-investments to have great influence on which sectors to expose their capital to, and at the same time benefit from lower aggregate fees, which then also acts as a cushion. And finally, and shifting our perspective here to also briefly consider the GP side, as that ties into fundraising as well. GPs are now taking much longer to close their funds as LPs delay commitments and tend to stay on the sidelines to wait out this period of perceived uncertainty. And we've seen this trend manifest really over the past 2 to 3 years. Fundraising timelines have extended meaningfully. Even the larger funds raised through this market in year and a half. These funds are now taking 2.5, 3 years to really go from first to final closing. So when looking at deal activity and deployment, GPs have acted more cautiously as volatile markets create uncertainty with respect to asset valuations, and then making it more challenging there for GPs to deploy capital. And this, if you think about it, adds another element of pressure to the system, as less deal activity on the buy side also means less exit opportunity on the sell side, less distribution. So you can see how all of this is related, and that less distributions means less capital for future investments on the side of the LPs.
Yeah, it seems, Stephan, that as you think about the risk backdrop and what's happening, especially with elevated financing rates, cost of capital increasing, again, we're back to that intention versus aspiration tension. More investors want to do more in these asset classes, but then it'll also be challenging to do so just given the backdrop, right? So navigating that will be a challenge. And then it comes back to, Matt, some of your points, then there is opportunity there. And Sebastiano, you mentioned it as well. So then you've got to really think about where to deploy and be very thoughtful about it. There's a lot of money coming in, but at the end of the day, you really got to get granular. Come to the next section, which is always a fun part of these podcast sessions, is headlines. When we explored current holdings with respondents to the survey, naturally, real estate, equity, and debt, private equity, and private credit emerged as the most widely held private asset classes, which is why the three of you are here.
A general consideration within investing is whether a given approach relies more on a broad macroeconomic assessment or whether an investment manager pursues more of a bottom-up analysis. Typically, both come into play to some degree. How these two core themes interweave can determine the success of any investment strategy.
Looking ahead to allocation increases over the next 2 years, the same asset classes are emerging as areas of focus, just as we're talking about, suggesting that appetite hasn't really topped out. So we found a few headlines in the media to draw on how this dynamic is going to play out and your reactions to it. So Sebastiano, I'll start with you first with an article from PERE. Managers are opting to ignore the macro for real estate. In this article, CBRE said the outcomes of elections in the US and Europe and Japan have made fiscal policy impossible to predict. Does this resonate with you? Is real estate a pure bottoms-up approach right now, or is there still a macro element at play?
There's definitely a macro element in play. That macro element might be less political or the tax regime or regulatory regime that you're in. You have to know this and you have to work within that. But I think the most important macro themes, which maybe in real estate are not discussed enough because we are such a slow-moving industry, is what characterize every other part of our economy. The digitalization, the AI push, all of those will change real estate structurally and substantially. I always try to remind our investors, don't only look at the cyclical element and the cyclical opportunities, look on the structural changes that will happen to the real estate industry with the change in our societies and economies. We call this future of core. The future of core real estate will look terribly different than what it was 20 years ago. And why should it not be if every other aspect of financial markets are changing rapidly? Yeah, just look at stock markets and the composition of indexes. So this is the first thing. So that's why we very much believe that the macro view about the right asset class and the conviction play are very, very important. But as always, you have to combine it with the bottom-up approach. And geographies matter again. Local markets matter again. All of those aspects matter again. It's not like in the low interest cycle where every ship got elevated. So this time it's about the right selection of the right strategies, the right local markets to really capture the growth that will come. More and more difficult, and that's why manager selection, strategy selection is so important and so relevant.
You're hitting that bottoms-up theme, so that makes sense. But obviously, some of the macro elements, just to untangle kind of where the opportunities are important too. Stephan, one from the FT for you. Private equity groups hunt for new exit strategies as cash piles up. Stephan, we talked about this a little bit already, but the article goes on to say investors must get creative to get out of a towering backlog of older investment and put new funds to work. What does this creativity look like? What's the outlook for dry powder as we go into 2025, as you think about all the dry powder already on the sidelines?
I think context is quite important here. Indeed, PE groups are sitting on record piles of cash. I believe there's three main reasons for this. As I mentioned before, firms have been slow to deploy capital given perceived volatility and uncertainty. At the same time, and very much interrelated, they have been much slower to distribute capital back to their LPs as well. And in fact, distribution activity has slowed meaningfully in 2022, 2023, and even year-to-date 2024. To give you one data point, the distribution level at this point in time is roughly about 10% of unrealized assets per annum, meaning that 10% of that unrealized value gets distributed out throughout the year. And this is quite relevant and interesting if you compare that to the historic average, which probably sits anywhere between 20 and 24%. And the last point I want to make here is that if you take a closer look at where this dry powder is concentrated, you will observe a considerable level of concentration risk, as about a quarter of that dry powder sits within the largest 25 firms in the market. And interestingly, these firms have raised significantly more capital by many multiples effectively than they have historically been able to deploy. So with all that, managers have plenty on their plate with assets held at arguably elevated holding multiples resulting from the post-COVID heydays of deal making, and there have been perceived gap or mismatch between sellers' pricing expectations and what prudent buyers are willing to pay. In order to get deals done, many private equity groups have indeed gotten quite creative and deployed financial engineering to bridge the disconnect between what buyers are willing to pay for and sellers expect to receive for a certain asset. In the secondaries world, we refer to these techniques as structured transactions or structured solutions. And these can take many forms, but let me give you 2-3 examples. So we're seeing a lot of earn-out components whereby a certain portion of the purchase price is contingent on the future performance of the underlying asset. Another element is deferred payments from sellers whereby a certain portion of the purchase price is paid at a later time. And the expectation here is obviously that the underlying asset will then grow into the agreed valuation over time. Last but not least, there can be rollover investments from the seller, and these can take the form of seller loans or equity investment, which can at times even be subordinated to the new buy equity then. So in terms of outlook, all these things considered, I believe that we will see a continuation of current trends with significant levels of uncommitted capital persisting into 2025 and beyond. As of mid-24, I believe the global dry powder had reached a volume of about 2.5, 2.6 trillion. And this is really driven, as we said before, steady fundraising in larger funds that is clearly not aided by constrained deal activity. That makes it challenging for investors to put capital to work and hence impacts distribution activity.
It comes back to Sebastiano's manager selection point being really important here, right? If you're trying to deploy into this asset class, you also have to be thoughtful about who you deploy with if you're an allocator. So helpful to kind of understand how different the landscape can be across private equity and secondaries as well. Matt, sticking with the FT here, a headline, banks risk coming late to the private credit party. The article talks about banks teaming up with private credit providers as the landscape has changed due to regulations and bank balance sheets and also the growth in private credit we've been talking about. Does this make sense? And is now the right time where you start to see these partnerships really take hold and maybe further drive growth in the market or opportunities?
Well, I think the thesis is entirely sensible. You're combining private credit expertise and flexibility of capital, unconstrained in the same way bank balance sheets are, with what the banks do really well, which is originate assets and originate business and have large teams of business developers that are out in regional markets finding companies and finding opportunities to lend. So I think the thesis works. And I remind investors when I speak to them, the first thing we talk about in private credit and privates generally is the power of origination. It's the most crucial asset you have as a manager, because the premise here is we have to do better than public markets after illiquidity. We can only do that if we manufacture and originate enough opportunities that are interesting and aligned with our risk mandate. And that means meeting with and talking to lots and lots of issuers around the world every day. So origination is crucial. And I think that's what's driving a lot of these partnerships, accessing bank origination. But I go back to one lesson early in my college career, which is concept of moral hazard risk. I think ultimately the success or not of these partnerships will come down to how aligned the partners and teams are on both risk-taking mentality and who's getting paid or who's getting, frankly, punished for taking too much risk or not enough. And I think those are the things that are ultimately going to drive behavioral characteristics of these partnerships that will either allow for them to be sustained or unwound. The final thing I'd say on this is, although certainly the headlines are much more prolific now around these partnerships, it's not the first time. There's 20 to 30 years of history where private credit and private assets have partnered with banks in different ways. I think the formalization of the effort here at the scale that's being discussed is the difference. And I think the other difference is it's now encompassing a much broader lens within private credit and privates generally. The article in the FT talks about not only leverage lending, which is popularly direct lending, but also asset-based finance, investment-grade credit, specialty and structured credit. I think those are the areas within private credit that actually have more utility with this program than traditional leverage lending. As the article implies, perhaps the banks are too late to the party over the last 10 to 15 years.
I think it's going to be a trend investors will want to watch closely on. I think, as you mentioned, there's opportunity there. The thesis is sound, but the how is going to be really important in terms of how this actually comes together and what risks and opportunities are introduced into the system. Coming to our last section as we wrap up, it's our quickfire round. So you have a minute each to share what you believe is the biggest headwind and tailwind in your space in 2025. Sebastiano, we'll start with you.
The biggest tailwind for me is the vintage. As I said, we have seen a reset of valuations, an illiquid market which allows you to buy from motivated seller. Specifically in Europe, we believe the time is now to buy because we have a structurally low supply. And I want to remind everyone that demand and supply, and especially the supply side in real estate, is super fundamental about rental growth perspectives. And the last thing is that we have this positive leverage and accretive leverage coming to the system through every cycle. It's pretty simple. When all of those things come together, market illiquidity, valuation correction, low supply, and accretive leverage, values will start rising again. And I think that's the biggest opportunity. The headwind is clearly that you have to be much more agile and much more bottom-up in all the approaches, and this means as well operational management. Real estate is much more operational and will be much more operational than what it used to be when you were just buying office lease agreements, and therefore you have to adapt to this by building proprietary platforms, joint venture structure, going into operational real estate. You have to be much broader and ready to go more into a private equity investing mode than you might have been before.
Thanks, Sebastiano. Matt, over to you.
Very simple for me. The headwind and tailwind are the same, and that's the M&A cycle and what that means for loan supply. I think about that two ways. In the current, more constrained M&A cycle, supply is tight. And of course, with increasing demand, as this survey no doubt reinforces from an asset allocation standpoint, that means returns can compress and integrity of investment structures can weaken in comparison to the comparable liquid alternative. On the other hand, if the M&A cycle improves and economic activity is unleashed, then I think you have effects. Number one, you simply have a recalibration of supply and demand, and all else equal, I think that's good for the investment proposition of private credit. And then the secondary point is you have an unlocking of the capital that's frozen that we've hit on several times in this conversation. Capital gets returned to allocators redeploy into new vintages, new strategies, et cetera. And I think there's a very nice reinforcing effect. So private credit markets looking for supply, how you originate around that when it's tight is a key advantage for a manager, but no doubt more supply, I think, will increase the economic activity and value of the asset class.
Thanks, Matt. Stephan, if you can take us home.
So tailwind for us, I think it's probably is the same for Matt and Sebastiano. We're part of a market that is growing with 20% per annum. So just this structural element of growth is probably the biggest tailwind that will continue to propel. As a secondaries manager, we're a derivative strategy. So as long as the primary market continues to grow, we will grow. I would argue that given the fact that secondaries is a more nascent asset class, there is catch-up effect at play here. So I think from that angle, we're looking good. Headwinds, very much what Matt said. I think we've said it plenty of times now throughout this podcast as well. This flywheel continues to run if there continues to be deal activity and distributions in order to feed the system. So therefore, right now, the biggest headwind that we're facing is that lack of liquidity.
Sebastiano, Matt, Stephan, thanks for the deep expertise you've brought on each of your asset classes. As I wrap up, I'll just try to step out a little bit and step up. Overarching takeaways from my standpoint as I listen to each of you. Number one, there is that tension between kind of the intention and aspiration asset owners and investors have with the reality of the how you get it done. And I think liquidity seems to be the consistent theme in terms of a challenge of how do you allocate where there is money coming in, but also not a lot of money coming out. I think then the how leads me to my second and third thoughts. My second one is the manager selection aspect here in your portfolio construction. As you think about asset classes, then you really have to make bets with managers in thoughtful ways because of that overall kind of reality of how you get there. And then three is the bottoms up piece. As you work with a manager and you evaluate what they're doing, not all of an asset class is created equal. So you really have to dig deeper and understand what's happening. Does a manager understand bottoms up? What's happening in a market with a credit, with a property, with a private equity stake or what have you? That really is what will drive your alpha and your investment performance. Don't forget, if you're interested in the stats we've discussed today, you can access the report, which features further findings at pgim.com/what's-your-alternative or request a copy at thoughtleadership@pgim.com.
Speaking of alternatives with Keshav Rajakapalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated. which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2024. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.